love the channel and find it useful in becoming a happy retiree. Subscribe today. You and I both know that this has been just this politically charged year, seesaw, so many cross currents, just kind of mired in quicksand. That's how I feel. If you really look at what's working, some things are working, some things aren't. Kind of a frustrating year to be an investor, and that is par for the course. We had so many years where we had low volatility. Markets rose, everything kind of just made money. If you look at a portfolio with 5, 6, 7 different areas of the marketplace, the vast majority of those areas just worked really well and really easily over the last couple of years. And this is one of those years where the markets start to test your patience as an investor, just a little bit stuck in quicksand. And a lot of that, it's because you can name right off the top of your head almost a dozen things that are building this wall of worry for markets, and we end up getting sidelined. Or look at markets, we're up, down all year long, and here we are at negative 0.02% for the Dow, well, almost into June. Here we're almost in June, or almost halfway through the year, and we've gone nowhere. S&P 500 is up just a tiny bit, but the majority of this year has been this consolidating market that is, again, can get very, very frustrating for investors. So if you think about, well, what's the garden variety worry today? Well, the price of oil, which we were worried that going too low. Now we're worried about it going too high. The Fed and raising interest rates too many times or too aggressively. This concept of basically an upside down yield curve is maybe what we should call it. It's the proverbial term is inverted. You might want to just call it upside down. It's not supposed to flip upside down, and we're worried. That is something we're watching very intently. Hasn't happened yet, but it's something to really take note of, because we know that causes or precedes a recession in America. It's basically done that 7 out of the last 7 times it's happened, so we got to keep an eye on that. We're worried about, hey, earnings have been so good, but have they been? You've maybe heard this concept, peak earnings. Peak means, well, remember, markets don't care what just happened. Hey, that race you ran was wonderful. That's great. Good for you. What are you going to do the next time around? And that's the same thing with earnings. I'm a company and I have a blowout quarter. Well, that's all well and good, but nobody cares. What we care about is the next quarter. So if you have this environment where earnings are the best they've ever been, and we effectively are just wrapping up earnings announcements for Q1, they're effectively the best they have ever been in the history of the S&P 500, up almost 20% year over year. Phenomenal earnings, right? We're happy with up 4% in profits for companies in aggregate. And here we are up almost 20% across the board. Why is it the market jumping up and down and hitting all-time highs? Well, the worry here is that we may be at what you'll hear referred to as peak earnings, meaning that, hey, we can't repeat that. The tax cuts added so much to the bottom lines for these companies in the S&P 500 and beyond that we're not going to see that same incremental boost again, because taxes got lowered, and that happens one time. And then we go from there, and the earnings can stay here and trend higher as companies do better and better, increase revenue, and effectively have more dollars drop to the bottom line. But the boost that we just saw because of tax reform, we can't keep having that same incremental boost. So peak earnings worry, wage inflation. We continue to keep an eye on how much our wages in America are going up, and we want them to go higher. We want them to trend up, particularly beyond inflation. But if it gets to be too much, then companies start to have their profits eaten and hit. So wage inflation a worry. Will the positive, the tax cuts, get wiped out because of all these reasons? A trade war with China, and there's something new almost every day. Whether it looks like we are in favor with China, then we're back out of favor with China, then we're going to do a deal to settle or save a Chinese cell phone component semiconductor company, and then we're not going to do it, and then we are going to do it. So we're worried about this trade war with China. We're worried about a real war with North Korea. Is the summit on? Is it off? And you put all this together, and it makes for this feeling from so many investors, you're just stuck. And that is a fairly normal period of time. It just feels, it's difficult to deal with, I know, for investors, because we're coming off such a couple really, really good years. So I want to kind of unpack a lot of these areas and see which components here do we have to be afraid of? What areas or concerns are on the marketplace should you really be worried about as an investor? And what areas can take this market way back into correction mode, or back down 10, 15, 20%, which of course is always the fear for stock investors. So we've got to remember a couple things here. It's still important to recognize that the potential tariffs, and I think that's probably on most investors' minds. Wait a minute, what is happening with China? Isn't that a big deal? Well, it is a big deal, but we've got to remember and recognize that the potential, and remember, these are potential tariffs that haven't really even begun to hit yet. They could be as much as an $80 billion hit, 80 with a B, $80 billion net negative for the U.S. economy. That's not a small number, right? But if you put together all of the areas that don't seem, that aren't getting a whole lot of press. So what's happening to the upside in 2018? So that's the downside, 80 billion minus from GDP in potential tariffs. But on the positive, we have tax reform that adds about $200 billion to the U.S. economy just in 2018, $200 extra billion that we did not have last year. Government spending is adding $100 billion that we didn't have last year. And then repatriation, that's all the cash coming back from overseas because of the new tax code. And we talked last week about what some of these companies are doing with, yes, $500 billion coming back onto our shores, $500 billion that's been sitting in cash. See, these are profits. The companies, tech companies, pharmaceutical companies have left overseas because they didn't want to pay U.S. taxes. Now, effectively, the government's saying, hey, look, you've got to bring the money back. You've got to pay this one-time tax on it. It's a much lower tax than you would have before the tax reform, and you're bringing it back. So companies are saying, okay, well, what are we going to do with it? Well, it's going to pay down debt. It's going to merge with other companies. It's going to increase dividends. It's going to repurchase their own shares, so their earnings per share go up. That's $500 billion added to the $200 from tax reform and the $100 for government spending. Well, my quick math shows me that that's an $800 billion net positive for the U.S. economy. $800 billion. That doesn't get a whole lot of press. What gets all the press is the maybe $80 billion that could be happening with trade. So we have 10 times the positive in 2018 from an economic standpoint than we do potential negative. And I think that's something we have to remember here as investors. We've got to keep our eye on the bigger picture, not just the scary headlines that newspapers have to do on a daily basis to grab your attention. Now, what about this concept of an upside down yield curve? Or an inverted yield curve that we've talked about. And we've had callers bring this up over the past couple of months. We've done a lot of work with this with our investment committee and the Money Matters team, and it's something that you really have to watch. And again, the worry, if this is a new concept to you, typically, if you look at this, the slope of what bonds normally pay, in the short run, if you have 1 or 2 year bonds, they pay, let's call it 1%. In the intermediate term, they pay 2%. And in the long term, they pay 3%. That's the way it's supposed to go. In an inverted yield curve, an upside down scenario, basically means that short term bonds pay 2% and long term bonds, let's say, pay 1.5%. So that a bond that has a shorter maturity actually has a higher interest rate. That's not the way it's supposed to be. And we're getting to the point where economists and markets are looking at this very intently and saying, well, we're getting closer and closer to a scenario where the yield curve that we've got to watch gets flat or then inverts. This is once that happens, and if you go back September of 1978, August of 1980, January of 1989, February of 2000, February of 2006, every single time we had a yield curve inversion. That's the last 5 times. 78, 80, 89, 2000, and 06, we got a recession. On average, it took 17 months for that to happen. So let's call it about a year and a half once we see this activity in the bond market, which we can watch every single day, crystal clear. We know that on average, you've got about a year and a half before you go into recession. So we'll keep, of course, extraordinarily close tabs on that because we want to be the first to say, look, there's enough economic indicators. And remember, it's not one data point, it's a symphony of data. When that goes negative, we want to be able to, we want to be very aware of that as investors. Because of course it will impact our portfolio decisions for retirement. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.